Good morning, everybody. Happy Monday morning to you. Welcome to the Monday Market Mortgage Meeting Update with myself, your host, Sean Patrick McGee, Grapevine, Director of Agent Direct. I am lucky enough to be joined this week, as with almost every week, by the Sultan of SLAs, the King of collateralized debt. He's the Colossus of credit, the Titan of the 10-year. He's the great Bambino. He's a man whom we previously considered as untamable as a caffeine-riddled Jerome Powell at the tail end of a global pandemic, but whose wild side has finally been reined in. And the holiest of matrimonies, I reintroduce to you the return of the man, the myth, the legend, Austin Koenig. Is that still your last name?
Yeah, we kept the last name. So all things are good. Thanks for the great intro. And yeah, went away, got married. Now I'm back, and it's time to mortgage, right?
Time to it's like your catchphrase that you're so famous for. It's mortgage time. You're always saying that right before you just like run off into a meeting. So
That's why I don't need to watch. It's always mortgage time. That's right.
Man, that's right. We're gonna get that embossed on your vest. Oh, I need to mention the ubiquity of vests in my next intro. So hold on, let me take note of it. Before we get on to anything unimportant, let me make a note on my very long Word document that contains all of the intros I've ever done for you, and just tell myself to mention his vest. So just stay tuned. Stay tuned until next week, everybody, where we will do our best to mention his vest. Anyway, welcome back, Austin. In your stead, a very capable Rob Piclo led the charge for mortgage time, and but we're glad to have you back. Why don't we just launch right into it, as we always do? Rob claimed it was a slow news week last week. Can you corroborate?
Yeah, it was. It was a slow week last week, but hey, I think you kind of need a slow week after a lot of news that 2 weeks prior to that. It was a busy start to April in terms of data. Kind of how like every month starts, but I think the really thing to put a pin in by any means is like look at the initial jobless claims and the continuing jobless claims that comes out every week. But we see that number start to become worse than expectations, and kind of coming at a little bit of a higher clip. It's not going to move anything really, but it's something that we're still seeing fairly decent job numbers. Unemployment rate looks good. The labor participation's strengthening from where it was after the initial parts of COVID. So we're kind of getting to a point where initial jobless claims it's good to look at, but it's not going to be moving markets. I don't think you should ever make the decision in your head. I will wait to lock a loan. I feel a certain way about initial jobless claims or continuing jobless claims. That's not what you should ever be thinking about. But it is a good thing to keep a track because you need to know about that data in terms of how the economy is faring. People that are losing jobs, are they going out to file for unemployment? Are they still filing for unemployment? Are they having a tough time getting a job? Those are things to look at, but I think everyone knows there's plenty of job openings still out there. So I don't think it's been a huge number that's fluctuated quite a bit, but it was a little bit weaker than usual.
Right. So things kind of going the right direction as far as what the Fed is wanting, we've just seen sort of a slow melt, huh? And I think the 10 years is exactly where you left it, and it's exactly where it just always is. If I was a betting man, I would iron condor this sucker right in the 3.4 to 3.6 range. It just will not budge. It'll go down on good news and up on bad news, but really it seems to regress to this 3.5% mean, which says to me that people think essentially the same thing they did about the future. They think right now the same thing they did a month ago, 2 months ago, 3 months ago, right? They're for all of the changes, they've sort of all averaged out into, this is like more or less where we thought we would be. So not good news, not bad news, just steady. And steady's kind of the name of the game. We're in the business of hoping for steadiness, right?
Yeah, and that's exactly right. So steadiness is very helpful when it comes to the mortgage secondary market. Really, unsteadiness is where we've had the most challenges. Think about, when we've had huge ramp ups in rates or even like kind of sharp decreases quickly. Like that's what causes the most frustration for our capital markets departments and every of our lender partners, right? Like that's like the biggest frustration that's typically deal with because it's such a moving target and it really makes it hard to get a handle for your pull through, but also it just makes it difficult to transact in the secondary market generally. So steadiness is good. Also, we have a pretty big thing coming up next week with the Fed rate decision. The next
Mhm,
Fed
mhm.
rate decision comes uh, mid next week, so May 3rd. That's Wednesday afternoon. So obviously we'll talk more about that next week. But I don't think there's really too much drama to talk about unless something crazy happens this week, which I don't think there will be anything crazy either. I think it's going to be kind of another slower week.
Mhm.
And generally, most people think 25 bip hike is what we're going to be expecting for the May meeting.
Yeah, they've telegraphed that over and over again, and at this point, like the Fed hasn't done anything to surprise us in over a year. It seems like they have. I think they've realized like you gotta say what you're gonna do, and then you gotta do what you said you were gonna do. Otherwise, the already just sort of like chaotic, choppy markets are just going to become even more chaotic and choppy. There's no real reason to launch a surprise unless they were faced with some huge new piece of information that like changed the course of where they were going to go in a week or two leading up. And it just doesn't even seem like there isn't even a piece of information that could come out to affect that. I mean, when's our next CPI print?
It wouldn't be till well, we do have a
The week.
PCE print
Mhm,
with all the GDP data that comes out at
mhm.
the end of this week. I don't think that'll really move things too much because we kind of have leading data to kind of help us get to that point for the most part. So I don't think we see anything drastic. And this is all backward-looking data to what we saw in March through January this year. So I think we're all kind of on the same page with that. I don't think that moves anything on any needles. When it comes to the next CPI print, for the month of April, we'll see that in after the Fed meeting, after the jobs report. So at least the second week of May, if I'm not mistaken. So that's going to be a little bit from now. I
I'm
think generally,
excited. I'm excited. I'm so hopeful. What are we at? 5? I
yeah,
always say,
I think it's what
there's
it is.
like
Yeah.
there's just not that many numbers between 2 and 5. It can't go down much further without being where we want it to be. So, as long as it keeps going down, which it appears that it is doing, or at least staying steady. So, yeah, I'm also PCE is going to be huge. It does seem like there really is no there's never any new news in a vacuum, right? Like, yeah, CPI is coming out, but that is sort of presaged by PCE a couple of weeks before that, and then PCE comes out, but it's like, well, we just got a CPI print, so it's like, luckily, like we're getting enough economic data that all sort of paints a similar picture, and it doesn't even have room for as much chop as we've seen in the past. So it looks like things are kind of steadying here. And what does that mean for liquidity? What does that mean for premium? Are we starting to see mortgage backed security markets stabilize? Is there a path to having some premium on some of these harder to premiumify loans?
Well, I think generally, when we're up here in this space, I don't think we still have much premium that we're used to maybe having back in the times where we're originating 4% mortgages or 3% mortgages.
Mm,
The premium's still not going to be as I think as you know juicy as we've previously had. But one thing to keep in mind too is MSR values are, and we talk about MSR values here every once in a while, but just to kind of keep in mind for everyone at home is, MSRs are kind of a natural hedge to all mortgage originators because think about whenever you're looking at floating a loan, right? Let's say you float it at 6%, and then rates really go up, and you look at that 6%, and now that loan costs more, right, to lock in for your borrower,
mm,
right?
mm, mm.
So that means the pricing got worse for it. The one thing that kind of counteracts that a little bit is maybe the price for the loan, like to sell the loan to the investor, is less, but the MSR value actually goes up when rates go up. So when like rates kind of stay at the steady point where they're at this level, and on the higher side, the MSR values for the lower rate mortgages are going to be continually attractive, and is something that you'll probably continue to see, like opening up the rate stack. We've talked about this through a lot
Sure.
of different meetings we've had, but opening up the rate stack is important when you're looking at pricing a loan for a borrower nowadays. It still holds true, and that's where we're going to be finding, I think, we're not going to see ultra premium to offer tons of lender credits. That's what makes the DPA programs through like the EPM Empower DPA, or the what AFR is famous for doing. Those are tough to do right now. But when we're talking about looking at finding a valuable rate, sometimes par might not be the best idea. If someone can pay 1% for points, it actually might be a great idea. They can get a huge amount of savings on their monthly
Sure.
payment.
Sure. Those
That's
payoffs, the turnaround, or like the payoff for it, like break even is, we've seen like 12, 18, 20 months. It's like, yeah, you had to pay an extra $3,000, but you saved that $3,000 in 16 months, and you're going to save it again in 16 more months. So as long as you plan to stay in the house for a year and a half, like, and as long as it's not going to make you cash poor, right? Like a lot of times we're seeing buying down the rate to and I take it, the reason that's because they're willing to take like a little bit less money for that rate, because they think, like a 6.5% loan is probably going to be pretty easy to refinance in the near to medium future. But in their mind, it's like, well, the life of a 5.5% loan is going to be much less likely to be refinanced anytime soon. Is that essentially like they'll make a little bit less money for a lot longer? Is that kind of the play?
Sure, you're hitting the nail on the head right here. So that's exactly what, like, so that's the psychology behind like mortgages in general, like in mortgage investing.
I'm learning
It's not
after
perfect
1 year.
because you're a great student. I think we're going to move you on to advanced here in a second. But so MSRs, like for example, what your psychology, thinking about, okay, I'm the borrower. What do I want to do? Oh yeah, I paid this money, but I'm actually going to break even really quickly. But it's still such a good rate. It's going to be harder to kind of refinance that rate possibly, or make the break even to refinance it again. That's what drives the MSR value up in a sense. It also drives for certain loans. Sometimes they want for a low loan balance loan. You see this at Windsor sometimes. They become actually priced better than the same loan, all things considered, just at a higher loan amount, because think of the dollar amount saved by changing the rate by 2% for refinance. It's just not as much. It's not as much of a break even. So those are the sort of things that actually kind of price into the mortgage economics behind investing and flows into pricing. So you're exactly right. MSRs are going to go up in value as you kind of go to the lower parts of the rate stack because those borrowers are less likely to prepay, and kind of there's a little bit more shielding. And the holder of the MSR, they get 25 bips every year that person pays. So the more times I get to 25 bips every year, the more money I make. I'm going to price the 5.5% loan to probably have more probability of giving me more 25 bip years than the 7% one, right?
Amazing. Makes sense. Okay. Well, that was an interesting and helpful explanation of things I'm still trying to learn. So we have, like you said, PCE at the end of the week. What about product or lender wise? I'm trying to get better about introducing that and kind of teasing or sneak peeking anything we have in the pipeline. What do you got cooking for us over there in capital markets?
Yeah, of course. So, to be honest with you, I'm in the middle of catching up, and I know Rob's been kind of doing a good job about this too. But probably more meat on this bone when we talk next Monday. But one of the things that is always happening behind the scenes is DPA programs, for example. We're always looking to add DPA programs where we're eligible. Those sort of things are something that we're always looking to try to partner with our lender partners that can offer that to bring this into the TPO channel, and get that something that you can win with. And I know DPA programs there's so many of them. There's so many different types, and some mean a lot more than others. We're constantly evaluating that stuff. So Rob, myself, and the rest of the capital markets team are always looking at that stuff. So, anytime you see something on the DPA side, feel free to send to Rob and I's way. Just include, at least a link to the information, so we can, take a look at that, see if we're even, eligible, or there's some sort of, next steps we can actually take to probably bring this to the, attention of our partners. There's a lot of them that are sometimes difficult to do in our current state of, not, being like set up with US Bank or some sort of correspondent relationship, but there are other ones that do make a lot of sense for us, and we can actually become eligible. And those are the ones we start working on and try to get approved as quickly as possible. So that's kind of something that's we're working on behind the scenes, and more information about that to come as we get approved with certain things. But those are some of the things that happen, as well as tons of other product and lender strategy updates. So.
Yeah, I love that we're starting to get more and more texture in our offerings on like a localized and regionalized basis. That is super helpful. We really appreciate the work that you guys do. We're excited to have you back, Mr. Koenig, and congrats on your nuptials. And
thank you, appreciate it.
You're welcome. Only the best nuptials for you. So enjoy your time back. Go get caught up. Thank you, everybody, for watching. Have a wonderful week, and go lock some loans.
Sounds good. Thanks, guys.